Presentation is for Accounting 221, Accounting Principles 1, Chapter 1, Accounting and the Business Environment. The first three learning objectives for the chapter are to explain why accounting is important and list the users of accounting information, to describe the organizations and rules that govern accounting, and to describe the accounting equation, and to define assets, liabilities, and equity. The last three learning objectives are to use the accounting equation to analyze transactions, prepare financial statements, and to use financial statements and return on assets to evaluate business performance. Now we will explain why accounting is important and list the users of accounting information. Accounting is the information system that measures business activities, processes the information into reports, and communicates the results to decision makers. Accounting is the language of business. The better you understand the language of business, the better you can manage your own business, be a valuable employee, or make wise investment decisions. Accountants participate in a broad range of activities, such as the investigation of financial evidence, the development of computer programs to process accounting information, and the communication of financial results to interested parties. Accounting is used every day to help make good business decisions. The Pathways Vision Model was created to help students and the public understand what accounting is and how it is used in business decision making. Accounting starts with economic activities that accountants review and evaluate using critical thinking and judgment. Accountants play a critical role in supporting a prosperous society. Accounting is divided into two fields: financial accounting and managerial accounting. Financial accounting provides information for external decision makers, such as outside investors, lenders, customers, and government entities. Managerial accounting focuses on information for internal decision makers, such as the company's managers and employees. Individuals use accounting information to make decisions such as how much money to save for college or to purchase a new computer. Business owners use accounting information to set goals, measure progress toward those goals, and make adjustments when needed. Outside investors have an ownership interest in the business and often provide money to get a business started. A creditor is any person or business to whom the business owes money, and taxing authorities collect taxes levied on a business's income or assets. Certified public accountants, or CPAs, are licensed professional accountants who service the general public. CPAs work for public accounting firms, businesses, government entities, or educational institutions. To become a CPA, you must meet educational and/or experience requirements and pass a qualifying exam. You can visit the American Institute of Certified Public Accountants, the AICPA website, for more information. Certified Management Accountants, or CMAs, are certified professionals who specialize in accounting and financial management. Generally, CMAs work for a single company. You can visit the Institute of Management Accountants, IMA website, for more information. Accountants generally work either in public, private, or governmental accounting. Studying accounting and becoming certified professionally can lead to a financially secure job. Tax accountants, auditors, and paraprofessionals or bookkeepers tend to service multiple clients and work in public accounting. Controllers, financial analysts, and cost accountants tend to work for a single company and work in private accounting. Other accountants work for federal or state governments. Demand for accountants is high, and employment is expected to increase over the next decade. Our next learning objective will be to describe the organizations and rules that govern accounting. In the United States, the Financial Accounting Standards Board, or FASB, is a privately funded organization that oversees the creation and governance of accounting standards. The FASB works with governmental regulatory agencies like the Securities and Exchange Commission, called the SEC. The SEC is the U.S. governmental agency that oversees the U.S. financial markets. Generally accepted accounting principles, called GAAP, are the guidelines for accounting information. GAAP is governed by the FASB, and GAAP rules are used to prepare financial statements. The primary objective of financial reporting is to provide useful information. In order for information to be useful, it must be relevant and have faithful representation. Relevant information allows the user to make informed decisions. Information that is faithfully represented is complete, neutral, and free from error. An economic entity is an organization that stands apart as a separate economic unit. An entity is a separate economic unit when it is separate from its owners. There are various types of business entities, including sole proprietorships, partnerships, corporations, and limited liability companies. A sole proprietorship is a business with a single owner. A partnership is a business with two or more owners and not organized as a corporation. A corporation is a business organized under state law that is a separate legal entity. A limited liability company, or LLC, is a company in which each member is liable only for his or her own actions. A corporation is a type of business entity that is separate from its owners in a variety of ways. It has legal corporate formation with the appropriate state. It has continuous life and ease and transferability of ownership. No mutual agency, so stockholders cannot commit the corporation to a contract unless the stockholder is acting in a management role on behalf of the business. Stockholders have limited liability for the debts of the corporation, and the corporation is separately taxable. Stockholders own stock in a corporation and are therefore the owners of the corporation. Stockholders normally receive one vote for each share of stock they own, and they control the corporation with their votes. Stockholders elect the board of directors, which sets policy for the corporation and appoints the officers. The board of directors elects a chairperson and designates the president of the corporation. Corporations have employees in various positions. GAAP provides the rules that govern accounting, which include the cost principle, the going concern assumption, and the monetary unit assumption. An organization that stands apart as a separate economic unit follows the economic entity assumption. The cost principle states that assets should be recorded at their actual cost on the date of acquisition. Assets will continue to be reported at their historical cost over their useful life. The going concern assumption assumes that an entity will remain in operation for the foreseeable future. The monetary unit assumption requires that items on financial statements be measured in terms of a monetary unit. In the United States, we use dollars because the dollar is the medium of exchange. Accountants assume that the dollar's purchasing power is stable. Inflation occurs when prices rise and the purchasing power of a dollar decreases. The SEC requires that U.S. businesses follow U.S. GAAP. Companies that are incorporated in other countries or that do significant business in other countries may be required to use International Financial Reporting Standards, or IFRS, which are published by the International Accounting Standards Board, the IASB. More than 116 nations use IFRS standards, which are typically less specific and are based more on principle than U.S. GAAP. An audit is an examination of a company's financial records and statements. In it, an independent auditor issues an opinion on the state of the company's financial situation. In response to various accounting scandals, the U.S. government passed the Sarbanes-Oxley Act, also called SOX, which is intended to curb financial scandals. According to SOX, it is a criminal offense to falsify financial statements. SOX also created the Public Company Accounting Oversight Board, or PCAOB, to monitor the work of independent accountants who audit public companies. We will now describe the accounting equation and define assets, liabilities, and equity. The accounting equation measures the resources of a business, what the business owns or has control of, and the claims to those resources, what the business owes to creditors and to the owners. The accounting equation includes assets, liabilities, and equity. Assets appear on the left side of the accounting equation, and liabilities and equity appear on the right. So the accounting equation is assets equals liabilities plus equity. Assets are something of value a business owns or has control of, such as cash, merchandise inventory, furniture, or land. Claims to assets come from either liabilities or equity. Liabilities are amounts the business owes. They represent the creditor's claims on the business's assets. Equity represents the amount of assets that are left over after the company has paid its liabilities, which is the company's net worth. Equity increases with owner contributions and revenues. Owner contributions of cash or property are referred to as contributed capital. Revenues are earnings that result from delivering goods or providing services to customers. Equity decreases with distributions to owners and expenses. Expenses are the cost of selling goods or services. Distributions of cash or property to stockholders are called dividends. The amount of cash or property invested by owners in the business is called contributed capital. Contributed capital is also called paid-in capital, and ownership is evidenced by common stock. Retained earnings is the equity earned by profitable corporations that is not distributed to stockholders. Dividends and expenses decrease retained earnings, while revenues increase retained earnings. The accounting equation is expanded to show the changes in equity due to contributed capital, dividend payments, revenues, and expenses. When revenues exceed expenses, the result is called net income. On the other hand, when expenses exceed revenues, a net loss results. Businesses strive for net income. In this section, we will learn how to use the accounting equation to analyze transactions. Transactions represent the activities of a business that affect the company's financial position. Only events that can be measured in dollars are recorded as transactions. Therefore, meeting a potential customer and hiring an employee are business events, but they are not transactions from an accounting perspective. Using the accounting equation, Smart Touch Learning records accounting transactions. In the first example, Smart Touch Learning is a new business to which Sheena Bright contributes $30,000 cash in exchange for common stock. In this example, cash and common stock both increase. An increase in cash on the left side of the accounting equation and an increase in equity on the right side of the accounting equation keep the accounting equation in balance. In transaction 2, Smart Touch Learning purchases land for $20,000 cash. In this case, cash is decreased by $20,000. At the same time, land is increased by $20,000. So essentially, we effectively turn one kind of economic resource, cash, into a different kind of economic resource, land. All the changes necessary to keep the accounting equation in balance occur on the left side of the equation. In transaction 3, Smart Touch Learning buys office supplies for $500. Rather than pay for the supplies at the time of purchase, the supplier has offered to let Smart Touch Learning pay later, usually in 30 days. In this case, office supplies is an asset, not an expense, because the supplies have not been used yet. A payable is always a liability. In transaction 4, Smart Touch Learning provides training services to customers. The customers pay cash for the services. Cash increases because Smart Touch Learning collects cash upon completing the service. Revenue increases because services are provided to the customer. In transaction 5, Smart Touch Learning performs $3,000 of services for a customer but does not collect the cash. The customer is not expected to pay until the end of the month, so accounts receivable instead of cash is recorded as an asset. Future payment from the customer is expected. Therefore, accounts receivable is an asset. The revenue is earned because Smart Touch Learning has performed the service. Note, the term on account can be used to represent accounts receivable if cash will be received in the future, or accounts payable if cash will be paid in the future. In transaction 6, Smart Touch Learning pays $3,200 for two expenses, $2,000 for office rent and $1,200 for employee salaries. Each expense is recorded separately and decreases equity. Cash is also decreased. In transaction 7, Smart Touch Learning pays for part of the office supplies that it purchased on account in transaction 3. This decreases Smart Touch Learning's cash by $300 while reducing the amount that Smart Touch Learning owes to the supplier. In transaction 8, Smart Touch Learning collects $2,000 from the client to whom services were provided in transaction 5. Note that while cash increases, the amount owed to Smart Touch Learning from the customer declines by an equal amount. In transaction 9, Smart Touch Learning distributes a dividend to Sheena Bright, thereby decreasing cash and equity. This exhibit 1-6 shows the 9 accounting transactions and provides a summary for the ending account balances. Notice the assets equal $30,500 and the liabilities plus equity also equal $30,500. We will now learn how to prepare the financial statements for a business. Using the data summarized in Exhibit 1-6, the 4 main financial statements are prepared. The first financial statement prepared is the income statement, followed by the statement of retained earnings. The balance sheet is the third statement prepared, and the statement of cash flows is the final report prepared. The income statement provides information about profitability for a particular period for a business. The statement of retained earnings informs users how much of the earnings were retained and reinvested in the company. The balance sheet reports the business entity's economic resources or assets, the amount of debt owed to creditors or liabilities, and the net worth of the entity or the equity. The balance sheet shows the financial position of the company. The statement of cash flow shows how it changed over the period. The income statement represents a summary of a business entity's revenues and expenses for a period of time. The income statement tells whether the business generated net income or suffered a net loss. Only revenues and expenses are reported on the income statement. The statement of retained earnings shows the changes in retained earnings for a business entity during a time period. The net income or loss from the income statement is transferred from the income statement. The balance sheet lists a business entity's assets, liabilities, and stockholders' equity as of a specific date. The balance sheet is a snapshot of the entity. The statement of cash flows reports the change in cash during the period. The ending cash balance on the statement of cash flows is the same as the ending cash reported on the balance sheet. The statement of cash flows is divided into 3 sections: operating, investing, and financing. Our last learning objective is to use financial statements and return on assets to evaluate business performance. Return on assets is a tool users of financial statements use to determine how well a company is performing. Return on assets measures how well a company uses its assets to generate net income. The formula to calculate return on assets is net income divided by average total assets. This is the conclusion of the presentation for Chapter 1.